think, it's particularly exciting and bodes optimistically for the market this time around because so many of these companies were actually changed and sort of shut down during the pandemic when it hit in March. But I think what happened is that a lot of companies cost cut. They digitalized and they found ways to compete in this new sort of environment. So while areas like the service sector certainly hit, you have these bright spots like Disney, and then also the top FANG names. I mean, they absolutely crushed it. So I think that any company that was sort of like online streaming communications, consumer discretionary, and had a platform, a technology for consumers to consume their services, did quite well. And I think that recovery and this earnings boost is a bright sign for the rest of the year and for positive GDP growth to come.
So you're saying for the rest of the year? I mean, we're only in February right now, Sylvia. So these themes,
Yeah.
these trends that you're seeing, it seems to me a lot of pricing has already happened. They've already been bid up quite substantially for many of the companies that you mentioned here. How much more is needed for them to keep that kind of trajectory, or do we level off a little bit?
I think that they've been bid up until they haven't, right? So we've seen a lot of these companies continue to grow. So take the FANGs, for example. In the beginning of the year, we were talking about at the highest valuations, it's time to rotate out, and they continue to grow through earnings. So I think that there's positive momentum in the market to come, just in general, because fiscal policy is so strong. Monetary policy will remain strong. We'll have more liquidity in the market than ever. Consumers will be getting back to life in America. And I just think that the overall recovery of the market will be positive for the names that are continuing to do well now and the names that have been sort of beat up. So I just do expect this to be a positive year, albeit with volatility. In the near term, we've seen these days like, the GameStop phenomenon we saw a couple of weeks ago and recent pullbacks in some of the top growth names. But in my mind, those are great opportunities to buy on the dip too.
So I mean, it sounds so financial advisors will call that the barbell, right? It's go with the things that are doing really well, right? That the trend is your friend, the big cap stocks and whatever, and then also go for some of the ones that are beaten up right now. If that's the barbell approach you're taking, what exactly then do you put in either side of those barbells, the heavy side, so to speak, between the handles or outside the handles?
Yeah, great question. So I think, I think when you allocate to quality names and whether you keep your investments in the FANG names like the Apples, the Amazons, the Microsofts, or you pick them up on the dips, we've seen a couple of pullback days. There are opportunities to get back in. If you're a financial advisor, you never get fired for having quality and cash on your balance sheet, right? These are good company names that continue to grow and return. And then in terms of the other side of it, look at the airlines, the hotels, the casinos, in your top five, the New York restaurants are opening back up, right? So that whole industry has been impacted so highly. And I think that once we get life back into America and people are sort of out there consuming, you might see some growth in those services. And thirdly, don't forget about innovation and disruption. You've got SPACs, you've got the 5G theme, you've got machine learning, you have all of these really exciting technologies in the market now, e-vehicles, fuel cell. There's so many different places to look for returns now.
Shepard Smith here. Thanks for watching CNBC on YouTube.